We've had a lot of questions recently, guys, about the VIX and specifically volatility. Everyone has probably heard the old saying that the market goes up like an escalator and then down like an elevator. So always going to be more volatile on the way down than it is as we're kind of grinding higher on low volume. We're going to talk a little bit about the VIX in this video and give you a few ideas how we can use it in our favor, guys, especially in a bear market.
Yes, sir. The volatility index, and it's actually more commonly known as the fear gauge, right? And the reason it gets called the fear gauge is because it's going to be tracking essentially the, options trading around hedges, put contracts, that people put on. Essentially, if you're holding long positions, you want to be able to put puts on so that you can hedge against downside. And the more of those that get bought versus the calls, essentially, you're going to have the VIX go up. So think about it this way. When the VIX is rising, people are afraid for their long positions, and they're trying to get insurance on it. And you see it scream to the upside. Now, it's not that it doesn't matter in all kinds of markets. I think the VIX is a useful tool in all kinds of markets. But specifically in a downward market, a lot of times, we're looking for places to buy. And if you look at the technical levels or look at some patterns on the VIX, a lot of times it will give you those setups. If I'm like, oh, where do I buy the Qs? Where am I going to buy Apple today? Where is the low? Because we're screaming to the downside at the open. Well, if you can find some of these wick levels, like I mean the other day when VIX broke to 27 and then just sort of slam back into the downside, that's where you could be looking for a reversal. And maybe instead of having a specific price level on an individual security or an index futures or an ETF, you could simply know the one you want to buy and want to be doing it off of key levels or key patterns trading in the VIX. So it's something that I have actually been looking at, and not necessarily as a front of my trades, but you know, when taking profit and when you're in the money in a position, a lot of times you might look for a slowdown in momentum in your direction. Maybe if the VIX keeps, if you're in a short position, that is, and all of a sudden the VIX finds a little bit of a top, hey, that could be a good place to take profit. So there's lots of ways you can use it for entry points, for trend reversals, for helping you with your exits. It's more about that market sentiment. And in a down market, it's just going to be an indicator you have to have out there. Even if you don't use it, it's good to have out there and be aware of it.
For sure, for sure. And there's UVXY if you want to trade a stock that's similar here. It's more aggressive, obviously, than just the VIX itself. But you're down 6%. And like Neil said, there's not too much to talk about. But when there's fear in the markets here, you know, you want to say to yourself, hey, I'd like to, you know, invest in something. So today, the markets are pretty calm. So this thing's down 6%, right? I mean, it's just, it is what it is. As the markets start to get excited, accelerated, so on and so forth, you get to see big swings here in a UVXY, right? So again, my chart's not going all the way back, but it's just, darn, it's not going back there either. But what it is, again, it's a way to hedge out your positions. A lot of us aren't very familiar with options or how to hedge out with options. But if you do get nervous about something, you can take a position in the VIX or UVXY. You simply do some studies and you can find other ones 3 times short, 3 times long. And all they really are is levered to the volatility. And as volatility increases, it's generally obviously to the downside in markets. So we look out for an extension of the VIX. Generally speaking, you know, when it's around 12 or 13 on the VIX, you know, that's pretty consistent. That's not too much worries. As it gets elevated, we just touched 30 the other day on the VIX on some of these moves. So again, it's a way to hedge out on some of your longs. If you believe, like, hey, look, I don't want to get out of my Apple. I don't want to get out of my Microsoft or my Google or some of these core positions, or you're waiting to collect dividends on those stocks and you just don't want to exit. It's not part of your strategy, but you feel like volatility is about to increase with things like the Fed, you know, changing course, going more dovish versus hawkish, so on and so forth. Right now it's hawkish, but you know, that will affect your current position. So this is just a way that you could take like an equity position in something to sort of hedge out against your longs, and let the professionals do it. They take longer term looks on both call options on the spiders and put options, put them together, wrap it up, and it's called the VIX. Do some work, but again, it is a hedge against your current long-term positions.
Yeah, a number of different instruments. We can look at the Ultra VIX if you want to get a little spicy, the UVXY. There's VXX, there's VIX, which is the actual index, but a gauge on fear. Throw an average true range indicator on a daily chart and understand how it moves on a daily basis and understand the range on a daily basis. And that gives you an idea how much volatility there is in the markets, guys. That's a little bit on the VIX.